All right, we're going to get rolling.
They helped create an economy that was completely addicted to cheap money.
You need to buy savings bonds or something. You need to be way, way, way out of this space.
I subscribe to Miss Piggy's rule of money management. Always manage to have more money, you know what I mean?
It wasn't but 2 years ago that everybody was saying China's economy was going to be bigger than that of the United States. It's gone in the exact opposite direction.
So we're going to jump right in.
Welcome to This Week in Mining, where we focus on making money in the mining and metal sector. And today I'm joined by Gareth Soloway. Gareth, it's great to see you again and great to have you on the show, man.
Hey, thanks for having me back. It's always a pleasure.
I love your content. I love staying up to date on how you're thinking about the market. So here's where I want to start. There's like a million different directions I want to go with you today, but we're a couple days after Labor Day, which means that summer vacations are officially over, kids are back in school, and more people are sitting down at their desk. Do you anticipate that having any impact, and if so, what, on the markets, on any specific sectors, any implications there, Gareth?
Yeah, that's a great question. And so one of the things we're seeing today is that we're seeing the stock market selling pretty heavily. In fact, there's a lot of areas that are selling. We're even seeing gold sell off today. And one of my thought processes is that you had the big institutional money that really took off the second half of August, right? And again, a lot of us take vacations around then, but really they're taking that full period off. The volume reflects that in the stock market. It was so light. And we had NVIDIA earnings, right? And NVIDIA earnings, we saw the stock down a little bit, but it kind of bounced and the buy the dippers came out. But because it wasn't institutional money, you weren't getting a real read on the market. Well, lo and behold, here we are back at work in September, and all of a sudden NVIDIA is down 7-8% today, and the stock market is collapsing. And so what we're seeing here is institutional money back at their desk, and they're making decisions and acting upon it. So I do think that now that we're back in September, you are seeing some repercussions to that, mainly from institutional investors being back at work and making decisions on selling.
And for context, we're recording on Tuesday, September 3rd. We're going to publish this tomorrow, so inside of 24 hours. Do you think this is a long-standing move, Gareth, or do you think it's institutional money coming back to the table and quickly shaking things out before they begin something else?
Yeah, so I'm leaning towards it being a bigger start to something going on here. And there's multiple factors for that. I mean, number one, we're seeing the yield curve, right? So we know that the yield curve has been inverted now for the longest time in history, but it's back to basically zero, meaning that the 2s and the 10s are essentially priced in terms of interest rates at the same point. So what we know historically is that when the 2s and the 10s uninvert, that's when the recessions hit. And you can look back in the data and see this. In addition, we're seeing other factors like the jobs growth is slowing. We saw last month the unemployment rate jump 0.2%, which was a big jump higher than expectations. So on one side, we're getting fed this kind of soft landing narrative by the Federal Reserve, by a lot of economists, but the data is not really backing that up, especially the historical data on what comes after periods like this. And so I think the institutional money is really ready to start cashing in and taking chips off the table. And I do worry that we're going to start to see this economic data start to get worse and worse. And the institutions are at the cutting edge while the retail investors continue to kind of buy the dip.
Right. Okay. That makes sense. Now, so thinking that through, there's a consolidation in the market that everybody talks about, right? The Magnificent Seven, or maybe even the Mag Five, depending on how specific you get. There's another consolidation that I've been trying to understand better, which is the percent of the market that's owned by which percent of Americans. And as far as I can determine, it's something as extreme as 10% of American stockholders own about 75% of the market. Do you think that's possible? Is that probably a realistic frame? What do you think?
I do think that's very, very possible. Now, granted, pension funds and stuff like that do make up some of it. But in terms of retail investors, it's a very small percentage. But that's why in periods like August, when the volume is this light, we can see that they can have that impact. Institutional investors are away. Retail investors have a bigger impact. And that's why once we get into September, in fact, September is known as being one of the worst months of the year historically. And I think that's part of it, is that the institutional money comes back that owns a majority, and and they can really bully the market up or down based on what they decide to do. And so the little things like this really are important. And I want to show you guys, I have a chart here I just want to show you that kind of, when I found it, it kind of freaked me out, to be honest. I basically, what I did here, and just to set the stage, is I was comparing the current S&P 500 to the 2007 top in the markets. And what I found here as we zoom in on this is that it's almost identical to what top we're forming right now. And what we can see here, this is the current S&P 500 right here. And we can see that we had this bull run up, 6% correction, and a low put in. Well, guess what? In 2007, you had a move up, a 6% correction, a low put in. We then had this huge move up on the S&P 500 in the current period, right? We saw that big move up before the recent all-time high. We then had a 10% drop. In 07, we had an 11% drop, same exact move. And what we know is then we saw in 2007, the next leg up, we came up to the previous all-time highs, just like we've done here. And then we obviously collapsed down. And I mean, I think we all, even if we didn't trade through it, we all remember what happened. We can see the drop of 66%. And so to me, I look at this and I say, generally human psychology makes chart patterns repeat, right? That's why technical analysis works, is because it's based off of human psychology. People are greedy, people are fearful, and therefore things repeat. It does make me wonder in this chart, are we setting up for something bigger? And then you look at some of the other issues out there, like, well, what's the U.S. debt doing right now? What's gold doing? Gold is performing really, really well because it's a safe haven, right? And even the fact that central banks are loading the boat on gold. I mean, if there's not a bigger signal to go into gold right now, I don't know what is. If the central banks, the ones that print the money, are loading up on it. So there's like these almost, it's like the market's giving us breadcrumbs of what to potentially expect. And I am concerned about the future, and there's no doubt about it.
So then this probably increases your conviction of, I want to talk about rate cuts for a second. And maybe here's a better way to jump into this one. Every investor I talk to and everybody I have on my show wants to talk about whether or not rates are going to get cut in September and how deep are rates going to get cut in September and all this. Is that the right question to focus on, Gareth? Like, do you think, a 50 basis point cut in September is really going to impact things enough? Like, is this the most relevant question that investors should be obsessing over? What's your take?
So I think that in general, rate cuts, we know they take basically 12 months to even integrate into the economy. So what you're seeing recently with the markets rejoicing over the prospect of rate cuts, it's the idea of them occurring versus the actual impact. And I don't think, honestly, 50 basis points is going to make that much of a difference. I mean, the Fed has raised it from almost 0 to 5.5%. 50 basis points is a token, but the Fed can't do too much. And again, the question is, are they going to do 25 basis points in September or 50? I'm leaning towards 25, although if we get a bad jobs report coming out this Friday, there is a chance that they could do 50. I am more concerned, and this is something else that I think is really important. If you looked at the Fed minutes that came out a couple weeks ago, the Fed actually discussed cutting rates in July. Now, we've seen Powell talk about, hey, listen, we may cut, rates have topped, we're going to cut multiple times. I start reading between the lines and I say, wow, the Fed was actually interested in cutting in July, but I thought we were on pace for a softer no landing scenario. Why are they so eager to cut? And what I arrive at is that it's likely they're seeing data that is really starting to scare them a little bit. And I think if we get a 50 basis point cut in September, you have to start asking, what are they not communicating to the market about the economy that we could be on the precipice of?
I mean, could part of that be that if 75% of the market is owned by 10% of the population, that 10% is going to be pretty friendly with policymakers? I mean, that's the top echelon of affluence. And so there's a lot of exposure there for some of the most influential people in America in a very frothy market.
Yeah, and that's such an interesting thing too, because I always deal with this of like, you have so much of the wealth tied up. There's this divergence between the rich and poor, even more so, right? I mean, every year, and I think the Fed realizes that them being so lenient on the stock market has really helped the rich get richer, and really the poor that don't have investments have gotten crushed because of inflation, right? And this is going to Dollar General. I don't know if your viewers are aware, but Dollar General recently reported earnings. They basically are known for being the lowest end of the consumer, right? The dollar, you can buy something for $1 in the store, but they basically said people can't even afford to go to Dollar General because they cater to this lower income. And with inflation, it's really hurt so badly. So there's this fine line that the Fed has to walk between wanting to keep the stock market up, keep the wealthy happy, while also saying, hey, listen, at some point, you're going to literally have a serfdom, right? You're going to have people that are so poor that they're basically, begging for food versus what's going on out there. So again, it's keeping the markets up to keep the economy. But also, I would say that they have to be aware that at some point, when we know this from history, if the poor get too destitute, they will rise up. And I think that's one of the things that I'm always concerned about. When I look at some of these bigger timeframes and these bigger charts, looking back at like 1929, the Great Depression, it's like, you can only build the bubble so big for the wealthy before those that don't have start to say, you know what, we're going to take things back.
Yeah. Okay, let me pull on that thread. Let me run an idea past you
Yeah.
with in relation to the high rate environment we've been experiencing. Is it possible that top 10% of individuals, let's just say homeowners, right? Just generalized, right? Sort of the wealthy percent of Americans that own their homes probably took advantage of the ability to refinance in 2021, 2022. And in America, that means you can lock in a fixed rate for 30 years. And so as a consequence, even though rates are climbing, put yourself in the position of like 65, 70-year-old American homeowners who are maybe retired or close. They have some savings. Those savings are parked in stocks, bonds, cash equivalents. So now in this high rate environment, their expenses don't actually go up because their mortgage and any debt they have, maybe it's long term, is fixed at that 1%, 2021 rate. But they're actually getting paid more now on their cash equivalents or money market funds. And so in theory, high rates are stimulatory for these individuals to an extent. And then the corporate parallel to that would be, big tech or, blue chip stocks who similar are able to negotiate long-term locked in debt, which they probably did in 2021 and 2. And so they've locked in their 10-year fixed loan terms at super, super low. And they also hold their treasuries in cash and cash equivalents, which are now paying them more. And so there's the top percent of the population, high rates were almost, maybe even stimulatory and good, right, for their balance sheet. And obviously the bottom 70%, the exact opposite. If you're holding debt on credit cards and you're far more vulnerable, I guess, and responsive to high grocery bills and all this stuff. And so the high rate environment continues to drive that wedge into that wealth divide even further. Is there a case for that? It's on the margin maybe, but what's your take, Gareth?
No, I do think so. And this is one of my big concerns, is that I do think the Fed is going to have to cut rates pretty aggressively. And my thinking is, okay, so you're right about that. People that had a ton of savings to be able to make 5.5%, basically with no risk at all, that was an incredible boon for them. While like you said, the lower income, they don't have the savings, they don't have the investments in the stock market, and they're getting crushed by inflation. And so as the rates get dropped, my biggest fear is that'll initially help lower income, right? We've already seen refinances of mortgages start to spike in the near term. But the problem is going to be this, is that right now we're sitting with inflation maybe at around 3%, maybe high twos. If they start cutting aggressively, where is inflation 3 years from now? Is it starting to now take that next leg up, which, by the way, we did see in the 1970s, right? We had a move up of inflation, it pulled back, then it had a bigger move up, pulled back, and an even bigger move up. And so this is where they have to be really careful, because if they're not, if they do this wrong, you're going to ultimately see that the lower incomes are going to get nailed again in, let's say, 3 to 5 years with another wave of inflation because of this rate cutting. And it's kind of in that whole philosophy of what I had, which is, this is unsustainable. I don't see how we can just have this massive debt pile, the Federal Reserve just increasing their balance sheet exponentially each bear market cycle, or even outside of a bear market cycle, and then reducing it ever so slightly and then expanding it by doubling it again. And same thing for the U.S. government. It is unsustainable. And the smallest or the poorest are always going to get hit the hardest, right? The wealthy, like you said, they're making 5% or more on their savings. They can obviously pay a little bit higher prices for food and energy. So it's kind of a train wreck that's occurring in slow motion. But it just pushes me more towards saying, okay, well, how do I protect myself?
Right. And in these major market corrections, it's a similar cycle, right? Where right now maybe we're seeing the big institutional money sell a very frothy top. And, then you have the hodlers who are going to, maybe they're too exposed to their position and they don't think they can afford to sell at a 10% loss and then a 20% loss and then a 30% loss. And depending on what percent of your net worth is tied up in these stocks, specifically the Mag 7, if you're too exposed there,
Sorry, and I was just going to say, and this happens almost every cycle, but it's even worse this cycle, meaning that the Federal Reserve, because of their lenient policy, and really the government because of their spending, they've basically made it so you've conditioned the retail investor to buy every little dip. Like as soon as you get money in, if you can afford to, it goes right in the market, because even if we get a 10% dip like we got in early August, the markets recovered almost fully within 2 weeks. When we saw COVID, the markets cratered, 30%, and then they recovered and went into all-time highs. And so we haven't seen one of these sustainable long periods where markets don't recover, and it's conditioned smaller investors, especially the younger generations, to just say, hey, just keep going in. Don't worry if you're down 5 or 10%, just hodl, right? That's the new term in the crypto markets. And I'm really concerned that ultimately will be a major factor in the ultimate undoing of this investment strategy. Because I think what's going to happen is just like in 07, right? 07, 08, 09, people got pushed, like the strongest holders of equities at the lows in 09, the markets fell so fast and so hard that people got whipped out. They finally threw in the towel. And where do they throw in the towel? At the lows. And so this is the way the markets work. The markets always make it trickiest on us. They push people to their limits. And I do think that the Federal Reserve is to blame in a way for letting the markets or helping the markets recover so readily so many times here.
Okay, so to wrap up this part of the interview, let's stick with a near-term time horizon, say year's end, right? We're coming into September right now. We've got half the year left here of market activity, essentially. Any major catalyst that you see? We've got American election coming up. That could be a big one. Any implications behind that you think are relevant and should be discussed? And then just general forecast, Gareth, balance of the year, market outlook.
Yeah, so I think the election cycle itself is going to be somewhat muted. I think now things are kind of quieting down there. I think prior there was a little bit more angst. It's going to be one of these interesting scenarios where it seems like policies, you might have tariffs if Trump wins, or just more kind of easy money and spending if Harris wins. But it seems like the markets are kind of more reserved to like, okay, that's politics. That's kind of the slow train going down the tracks. The faster one that I think is most important is the Federal Reserve and the U.S. economy, right? So if I'm right and we are close to or in a recession by year end, then I do think the markets are close to a panic. And again, one of the things we've seen, and I showed that chart of the S&P 500 from 07, is that the market, when it makes tops, has these big dips like we saw in August here. And then it recovers very quickly because the buyers just, say, oh my goodness, I can't believe I can get it at 10% discount, right? They buy it right back up. Yeah. But eventually, as it drops again, less and less people buy the dip because they already put all their money in the system. And then, like you said, in general, investors don't want to sell for a 5 or 10% loss until it gets to be 50, 60, 70%, and then they fold. And that's the biggest issue here, is that I do worry eventually we're running out of retail to buy these dips.
That's the fear and greed balance, right? When you're down 5%, you're feeling greedy, like I can make it back. 10%, you're feeling greedy. 30% fear starts to overcome. You're like, 30 could become 80. It looks like all of a sudden 30 could become 80, and then fear overpowers greed and you hit the bid at the worst time. Which is why I appreciate your take, because you're very good at stepping back from emotional reactivity and looking at the data, Gareth. Real quick break here, guys. If you are a mining investor, you are without question familiar with the Golden Triangle region in British Columbia. This is one of the most prolific mining regions in the world due to its vast deposits of gold, silver, and copper. Now, for the last 4 years, Dolly Varden Silver has been busy expanding their high-grade silver deposit in the Triangle, and they are backed by some of the smartest investors in the silver business, including the legendary Eric Sprott, Hecla Mining, U.S. Global Investors, Fidelity, Delbrook Capital, Sprott Resource Corp, and more. If you are curious why the smartest money in the silver business is cozying up to Dolly Varden Silver, then hit the link beneath this video. Okay, so yeah, I was looking at some of your charts prior to this interview and just thinking through how vulnerable the market looks right now. You know, we had the Iranian sort of war scare in April, massive sell-off, right? The yen carry trade unwinding in August, massive sell-off. But in both cases, very quick rebounds at the same time. And you got to wonder, like, what is the straw that's going to break the camel's back? You know, is there one? But and it could just be general recession fears or post-Labor Day institution decision delayment now being employed, something like this.
Yeah, and I would just say I think it's a little of everything, right? It's going to be the straw, multiple straws that ultimately break the camel's back. And I think the big one here is the AI trade starting to become like kind of an afterthought. Not an afterthought, not to say that it's not going to be a significant part of our lives going forward, but just you had these stocks that were growing at, you know, exponential rates, and things over time as they grow just can't grow at those exponential rates as fast anymore. And so even with Nvidia, we saw their earnings were amazing. It just wasn't quite the same growth that they reported last quarter. And probably going forward, I think institutional money knows that that's the way it's going to be. In addition, we're now starting to see an economy that's slowing down. If we continue to slow, then you can't, how do you justify, you know, Microsoft, Apple earnings, PE ratios in the 30s, right? Historically, a company like Apple would be in the 15 range. I mean, that's a 50% haircut. So even if we don't get to that point, just a reduction into the mid 20s brings the stock market down pretty significantly. And so I think valuations coupled with a slowing economy where earnings numbers come down pretty significantly, that can really be the kicker here. And then you throw in other things like the black swan events, right? Is there another war that breaks out? What about China and Taiwan? What about, you know, the debt scenarios? What about the Nikkei and the yen carry trade? Like, there's so many things that the market's been ignoring for so long, but eventually I do think that stuff like this will start to matter.
Yeah. And these fracture lines seemingly come out of nowhere. I mean, even the Silicon Valley banking crisis for most people, it was like, where did that come from? And then it was huge, right? Yen carry trade, where did that come from? And then it was huge, maybe not as big as people anticipated. Well, it's hard to judge in real time, right? Because it's so easy to be sensational and hyperbolic. Oh, the carry trade's way bigger than we think it is. And you don't know. It's impossible to measure that, actually, right?
That's right. That's 100% right.
Okay, so pivoting then to, I want to talk about something I'm watching right now on the street. And so, my world is very much the junior mining world. I host a very large conference in that sector and another podcast very focused on it. And, I make it my job to stay on top of deal flow. And I'd say I've seen a massive uptick in deals hitting my desk in the last 2 months. But specifically, I'd say they're very high quality, meaning the most credible institutions and check writers that I know are putting their chips on the table right now and positioning right now. And individuals like, everybody knows names like Rick Rule, but the biggest check writers in the sector are names that you don't know. They're not public figures, but they're behind the scenes making tons of dough when that market starts moving. And so I'm reticent to say like that tells me anything about timing. I don't think it does, because big money has a lot of patience and you can put chips on the table and wait for years. And I've seen it, but I am seeing these moves being made and I'm seeing the deal flow increase and a lot of positioning happening right now in the early stage gold equities, which is notable because we know gold has been hitting all-time highs. Yes, been selling off here last couple of days, but it's on a year tear. Central bank buying's been on 40-year records. There's a lot of evidence to support that higher gold price should maintain. Love to know your thoughts on that. First, let's start with that, Gareth. So gold outlook, balance of the year, where's your head at?
Yeah, so going into this year, I had a $2,500 price target. It was trading around $2,000. Amazingly, it's gotten there even before year end. I still think, and I'm on that case, that I do think there's further upside in gold into year end. I have an upside target. I'll show you guys in a minute on the chart how I get it, but it's basically $2,660. And again, that could be early 2025. Now, I will say just short term, the technical signals are showing us that there may be a small pullback in gold. Part of that is a negative divergence on the RSI, right? So what I'll do is let me bring up my charts real quick here, and we'll go into that just to give everyone kind of a view of what I'm seeing here. So let's look at gold. And so here we have gold, right? And what we do know about gold is that we've been hovering in this basically all-time high zone here to the upside. But we are starting to pull back here. And I just want to show this. So for those of you out there that don't know, I'm going to take off these trend lines so we keep it as simple as possible. And I'm even going to simplify this even more so. Let's get rid of that just to keep it as easy as possible to view. Now, what we have here is we had a high on gold in July and then a new high in August, right? New all-time high. But if we look at the RSI here, the RSI was down sloping. And so this is what's called in technical analysis a negative divergence, where price is going higher, but the RSI, the relative strength index, is going lower. And so these are just little breadcrumbs that tell me things like, okay, gold has had a great run. It might just need a breather. It might just get a little bit of a pullback here. And that's kind of where I'm at for the next 2 to 4 weeks. Little bit of downside, nothing crazy, but I do think, something in this realm here. Let me just draw the trend line. Something like this. This seems like a very common retrace back to about $2,425. Now, that's not a big move by any stretch. So it's a small pullback. If it breaks there, then you're talking about a little bit further downside, maybe to 2285. But all in all, and again, please understand everyone watching that net, I'm very bullish on gold. I think it's going a lot higher. It's just these little breadcrumbs are telling me that price may need to consolidate and pull back in the near term here. All right. So again, potential, these would be your 2 support levels down here. Now, just turning to the upside of where I kind of mentioned the 2660 level, what I did was I went to my logarithmic chart and we flip over to our longer term view and go back to price in the 1970s. And if we take that high from 1970 and we stretch it out to here, and I apologize, I have to flip over to my logarithmic chart. There we go. We got that up. But if we take that high from 1970 and we stretch it out, there is your upside target zone, which is right around 2660 to 2675. And that would be your kind of early 2025 high based on technical analysis. So I do think we're going higher. I will say that I think in 2025, we probably even go as up to later in the year 3,000. But just be aware that it's not linear. It doesn't necessarily have to happen in a straight line.
So maybe pull up that chart one more time with the RSI index for me, Gareth. The gold trend has you very bullish, but the relative strength index has you considering a pullback. How is the relative strength index calculated? Like, how is this determined?
So it's basically by finding out. So, and to be honest, I'm not 100% sure the exact calculations of it, but essentially what it tells you is that overbought would be above 70, under or oversold would be below 30, and it calculates into impact essentially what the general, I would say, sentiment is, right? So it's almost like institutional money flow.
Okay.
So what we're seeing here is when we see a negative divergence on the RSI, we're seeing that money flow, even though price is going up, money flow, big money flow is starting to come to the downside here. All right. So again, that's telling me that there's big money that might be taking some profits up here versus what we're seeing in terms of price, which a lot of retail would look at that and say, oh man, this thing's going to the moon. Mm-hmm. It just basically is a cautionary signal that we could get a small pullback.
Yeah. Okay. And so historically, this tends to signal when something has become overbought or oversold.
That's right. That's right. So again, the only thing, it doesn't necessarily tell you, hey, we're going to crash in gold, because it doesn't tell us that at all. It just tells us that price may need a breather here to consolidate and kind of build a new base, and then it can make its next charge up. And we always have to remember that charts work just like humans, right? So if I were to run a marathon, and by the way, right now I'm not in the shape, I think you are, you run, you might have done marathons.
I do.
But you know that when you run a marathon, if someone turns to you and say, hey, go run another marathon, you're going to be like, what the heck, man? Like, I'm exhausted. So what do? You need to take a break. You need to refuel, rest, and then maybe in a few days you can run again. Charts are the same way. They run their marathon and then they need to consolidate and energize again. And that's really what I'm seeing in gold, just needing a little time to consolidate.
Yeah. Okay. Now, when it comes to the gold equities, they've been relatively lackluster, but not so much. I mean, the producers have been doing okay. I was really waiting for earnings to come out, and a month or so ago, we saw very attractive earnings come out of, VRIC and Newmont. And Anglo was flat sort of year over year, but a lot of the major miners were up. And my one hypothesis I held was, well, institutions are going to wait for that. Retail investors can jump in on sentiment, and they do all the time, right? Gold price is up. I want to be positioned. That's enough of a thesis. But institutional money is going to wait for earnings and then make their decisions. And so what's your take on gold equity performance? Any thoughts you want to share, Gareth?
Yeah, so I'm just brought up the Newmont mining chart, and the Newmont mining chart's having a pullback, but it's just been so incredibly strong. I mean, so incredibly strong. But I think what's important to look at on Newmont is that if you zoom out, I mean, gold's at all-time highs, but Newmont mining is still well below, like 30+%, 40% below its highs, even more than that. It looks like 50% below its highs. And so it's important to understand why that is, right? Why isn't Newmont at all-time highs? And the answer is that during the 2020 to 2023 period, price of gold was not going up, but their costs were exponentially increasing. Labor, equipment, drilling, all these type of costs because of inflation. But they weren't able to capitalize. In fact, they were taking hits. They were losing money because of that, because of those costs, but gold wasn't going up. Now gold has started to compensate them. We're starting to see those earnings coming through. And what I think is the higher gold goes, as long as gold, if I'm right on gold, and it does go to 2660 and then 3000, the miners are going to be an amazing opportunity because their costs now, they might go up 3% a year, but if gold can go up 10% a year or 15%, then they're just printing money, and it literally becomes a printing money situation. And so this is where you get into the juniors, where the juniors historically struggle because they need price. They're not as big as a Newmont, but they can really capitalize if they find some gold on making profits as well. And so I like this. I would say on Newmont, I'm saying to myself, I'm not in Newmont right now, and I'm looking at it. I'm like, you know what? Let me let it pull back a little before I jump in. But I do think that the miners are a place you buy the dip on at this point.
Okay. And in the event of just thinking back to your 2007 comparison, you're pulling up the charts and showing, we're mimicking a lot of chart behavior from back then. In those massive corrections, everything gets sold, correct? I mean, even today, right? Even gold's, getting whacked a little bit. So your take in that major correction, Gareth, everything gets sold, no safe harbor. What's your position?
So when there's panic, there's no doubt about it. We saw it in COVID in March of 2020. Gold sold off, but then it recovered and went higher, right? If we look at 08, 09, gold sold and then it went higher. But again, what's interesting here is that if we look at gold, it was in an uptrend going into 08, 09, right? And then it fell because there was panic, right? And people they ask questions later. They sell and then ask questions later or think about it later. But then look at the continuation that took place into 2011. So you bring up a great point of saying, well, let's look at that. I mean, if we are replicating the S&P, you could get a pullback, right? I mean, what was the pullback here? In fact, we can do that measurement. So gold pulled back about 30%. I mean, that's a big pullback. But if that were to replicate, but then be inside of the bigger move up like this, I mean, that's okay, right? I mean, here's a 410% move from the low in 04 to the highs in 2011 with a big 30% correction to buy the dip essentially in between. And so I actually agree with that. I think that, I think everyone should have some gold in their holdings, just being a diversified investor. But it's all about buying these pullbacks. And if we do get fear, Bitcoin gets crushed, gold probably falls really quickly, buy that dip on gold. Because ultimately, like I said, we talked about this earlier, I mentioned this earlier, the central banks are buying crazy amounts of gold. And they're the ones that know they know what the ultimate outcome of what's going on is going to be, which is more printing.
So, yeah. And I love that take. You gotta keep some powder dry to participate. I mean, post .com bust, massive market sell-off, massive market crash, leading into a great gold market. 2008, massive sell-off, massive crash, leading into a great gold market for junior miners included in both cases. But you got to have some dry powder to participate in those low valuations, right? So what's the prudent portfolio look like today, Gareth, from your perspective?
Oh, that's a tricky one. So I can just speak for myself. I'm about 20% allocated to gold and other metals. Silver is my smallest holding. I have some platinum and palladium that I like as well. Both those charts. In fact, palladium I'll bring up the palladium chart. It's been consolidating here, but it actually looks reasonably attractive if it can break above this 1,000 zone. I mean, look at this long base of consolidation. And again, a breakout would be very intriguing to me. So I think, again, basically 20% allocated towards the metals, with a majority in gold at this point. And then for me, I'm looking at, I have a decent amount, about 40% short the market right now, NASDAQ, S&P, some of these other players that I just am looking for these bigger down moves. And then I have a sprinkling of long plays with about 20% in cash as well. So I have some longs. They're mostly been, the longs that I have are ones that have been beaten down and kind of forgot about. Like, for instance, Walgreens. Walgreens is one of my long plays right now. I'm not a long-term investor in Walgreens because their debt is insane, but with rates coming down, with the stock price where it is, I do think it starts to make a little bit of sense. And you can see, again, look at the long-term trend on this thing. It's been beaten down, and they are still profitable. So as a swing trader, I'm long this, for instance, just to give you guys an idea, but obviously not for the long term, just looking for a 10, 20% move, and I'll cash out. But really, again, I have about 20% in cash ready to deploy at the next opportunity, and about 20% in the metals at this point.
Is that the most important, like, thinking that through? There's going to be a variety of positions that you hold because of where you have your competitive advantage. And every investor should think that way. Like, I'm overexposed in relation to a lot of investors to junior miners, but it's because I have a competitive advantage in that arena.
That's right.
I live and breathe it, man. So, go to where you have a competitive advantage.
That's right.
That's just, every investor should think that way. Maybe the one common denominator, though, is that you're sitting 20% cash. That's the dry powder. It's really hard to do that for a lot of investors, right?
It is. It is. It also helps when you can, there are certain brokers out there that are paying like 4 or 5% on that cash right now too, which is very, very helpful. But I agree. If interest rates were zero, it would be even harder to just have it on the sidelines, because you're losing money to inflation at that point.
Okay. Got it. Now, so let's dive into a couple other metals then. You said silver is your smallest position. Why is that? And do you look at other industrial? You could qualify silver monetary or industrial, but do you look at other industrials like copper and nickel? What's your take, Gareth?
Yeah, so you can see silver's really rolled over recently. I mean, it had made a beautiful move up to about 32.50. That seemed to be just before we saw that correction in early August, where growth was starting to be questioned, right? Okay. And here we have, again, this recent rollover here. Now, there's a lot of support coming up on silver right here around 27.50 to 27, with additional support around 26.50. But the biggest issue for me is that when I invest in metals, it's mainly for that store of safety. How do I protect myself with the money printing that's going on, with the inflation that potentially is out there? What happens if the stock market collapses? And gold is that main focus, while silver, like you mentioned, is at least 50% industrial at this point, right? I mean, 50%. You might say more or less. I'm not sure, but the idea is, again, is that's going to be weaker if I'm right on the economy, right? If I'm correct that the economy does go into a recession, then in theory, silver probably underperforms gold during that period.
Okay. And then, so what's your take on copper, nickel right now? Do you have a thesis or opinions on copper, nickel right now?
Yeah, I've been analyzing the copper chart here, and really we've had this tremendous reversal. So you had this amazing move up earlier this year, and then copper's come right back down. We can see how it came up right here, this former pivot. That's going to be resistance, and it's gotten rejected. So the big thing that I'm watching is this level. If this $4, $3.95 level gets taken out to the downside, that would be very negative for the economy. And I actually watch copper as an economic indicator. You don't get it it's not like the jobs report, but actually copper can be a great way to globally analyze what the economy on a global sense is, not just the US, but obviously with China and the rest of the countries out there. So again, I'm $3.95. If you don't want a recession, you do not want copper breaking below $3.95. If that happens, that's telling you something.
Care to speculate with the probability there?
I think it's going there. I favor 70% chance that it breaks below here. So I do think it's likely, very, very likely. And again, one of the things too to keep in mind is China hasn't recovered. I mean, that's a very interesting aspect of, does the U.S. have a fate like that? If we slip into recession, can we recover? I mean, if the Fed, how much does the Fed have to cut rates? And then what is the long-term or even short-term implications of that from a fiscal spending side of things, and also from an inflation side? Does it kickstart that inflation that then handcuffs them from being able to cut rates as much as they want? And these are all questions that obviously we'll find out. But I do think it's coming, and unfortunately, it's going to be a tough period for us.
Okay. Do you watch emerging markets much, Gareth?
I do a little bit, yeah. Hang Seng, Brazil, some of the other ones, yeah, absolutely.
So do you think in a rate cutting environment, maybe based off some of the stuff we talked about thus far, there's a decent chunk of the American economy that's desensitized to rate increases and therefore desensitized to rate cuts? Emerging markets would be the exact opposite because they hold short-term debts. They're very subject to those rates. And so there could be some big winners. There's been some big losers in a high rate environment. And so the inverse is probably true. Which are there any markets you're specifically interested in or bullish on?
Yeah, so there definitely is, and just looking at this EEM chart, I mean, you can see back in 2020 it was all the way up here, and it has recovered off the lows, but it's still well off the highs at this point. So to me, this is actually where I think the interest should be for investors. So what we've seen is since 2009's lows, we saw money flooding the U.S. markets, which has been part of the reason why valuations have gotten so high. Is it's not just U.S. money, but global money rushed in. The Fed is the best. They know what they're doing. They're the most trusted central bank. The U.S. economy is the best in the world. And I think it's over allocated in the U.S. And what I'm looking for here is actually emerging markets to start to do a lot better. Partially, I think the commodity trade, right? I think if these metals, if gold does better and better, that's really going to help a lot of these. Uranium is an interesting one as well, as it's getting really low. Even lithium, LIT is a ETF, and I'm tracking this trend line right here. We haven't broken out yet, but I mean, this thing has been absolutely crushed. And obviously lithium goes with the EV trade as well, which hasn't done very well lately as well. But the idea here is that emerging markets should see a reversion. So all this money flowed into the U.S. When the U.S. starts to stumble and the Federal Reserve admits that there's a recession, there's going to be a little bit of a confidence loss factor. And I think also the interest rates being lower is going to drive money into these other economies. So I like Brazil. Obviously, Brazil has a bunch of issues right now as well, but other ones like that, Brazil and some of the other South American countries, anything that's basically trading far down. I even kind of, believe it or not, I kind of like the Hang Seng market and the China market here. If we bring up this chart, the chart is actually very attractive. I mean, so far off of its all-time highs of 2018. And here we are at the low end here. And I think, again, China could be a place that people say, okay, it's already been discounted. If you look at Alibaba, Baidu, a lot of these companies, 8 PE ratios, 8 versus Microsoft at 32 or 35, right? So there's the valuation has already been subtracted from these names. Now, granted, Taiwan is always the elephant in the room. Hopefully it doesn't happen. But aside from that, this is where you want to kind of look for that next leg up in a market.
Yeah, interesting. Okay. I was chatting with Lynn Alden recently, and she had a very similar take on Chinese equities. It's always notable when a couple of guests are aligned on something, a thesis.
That is interesting. Yeah. She's great at what she does too. She really is.
Yeah, 100%. Wild news out of Brazil. Full ban on X, by the way. Yeah. What's your take on that, man? Do you have one?
Oh my goodness, man. I don't know. It does concern me a little bit, the whole free speech thing and everything like that. And again, is it the roadmap that other countries are going to follow, right? I think that's the biggest concern. Do I care that much about Brazil? No. But does it set a precedence where other countries, and we know Australia's kind of been, fighting a little bit in this area as well. Does it just start this path? And it's a slippery slope. And I think you have to, whatever country you're in, you have to be a little concerned. I don't necessarily agree with everything that is said on X or even agree with everything that Elon Musk says. But at the same time, it is a very slippery slope, and that free speech has to be protected.
Yeah. That's it, isn't it? Like, not agreeing with everything that is said is kind of the point.
Part of it. I agree.
Imagine, right?
I agree with that.
All the messaging we full-heartedly agree with. Okay. So tying a couple of these things together, the Fed is sort of stuck here a little bit. They are very much impacted by high rates that they set, and then they have to pay interest on their debts. And, the whole concept of fiscal dominance, we're sort of entered that spectrum and continue down that path. It seems to be sort of a one-way street at this point. So in response to the rest of the world watching this occur, trends in central bank gold buying, you think this is something we'll continue to see? Will this, we're halfway through the decade. It's been a crazy decade. We're only halfway through, but every year something major's happened. And I have reason to think that that's probably going to define this next 6-year period. Do you see continued decoupling from the US dollar as a trade currency and a reserve currency for more economies around the world and looking to hedge their bets in either more diverse currency holdings or the lifeboat that is gold? What's your take on that trend, Gareth?
Yeah, I do think that trend continues, but I would just caution investors to understand that it's a very elongated process.
Yeah.
So it's not something that occurs. There was so much hype earlier this year about de-dollarization and this and that. And what we know is that the dollar is kind of the most slow moving thing out there until it isn't. But it has to get like the biggest moves in markets, right? When a market tops, it slowly kind of moves down. It's only at the very end where it collapses. And I think that's something to remember. So my guess is 5-10 years out, but yes, it will continue. I think that you have this kind of protectionism type thing that's taking over, right? I mean, we're seeing, the tariffs with China, these other countries, we got to produce everything here. They want to produce stuff there. That's going to cause this feeling of okay, we have to be off the dependence on the dollar. So I do think it continues, and I do think it pushes more people to gold. And then, the bigger question is, will it eventually push it towards Bitcoin as well? And that's really up in the air at this point.
Okay, let's wrap with that one because you've usually got an interesting take on Bitcoin outlook. So what are you watching right now?
Yeah, Bitcoin. So Bitcoin's in a tricky spot right now, and I'll flip up to my charts here so we can take a quick look. Is that basically you're holding steady in what I would consider a weak short-term position. So we have our pivot line here, right? And the pivot line means that if your price is above it, that's bullish. Below it, it's bearish. Now, we have this bigger channel. So you have a parallel line here, a line here. This is parallel up here. That, if we fall, is your support level. That's support 1 and support 2. As long as we stay in this general range above 49,000, Bitcoin would be viewed as being slightly bullish here with upside potential over the mid to longer term. I do worry, though, that if the stock market drops like I think it could, just like gold will fall, Bitcoin will fall as well, as people just sell and ask questions later. Now, like gold, I expect Bitcoin to recover quicker than the stock market. But I do think, again, the big thing for me is if it breaks 49,000, watch out below. You could be headed into the 30s. Okay.
And that's sort of near-term outlook, long-term, still very bullish, Gareth?
I do. I mean, there's always the unforeseen. And I think as an investor, again, it's all about allocation, right? So I do have a little bit allocated to Bitcoin, not tremendously because it's still relatively new, but I can totally understand why people want a form of value, of digital gold, if you will, that diversifies them away from currencies, from fiat currencies. And gold does that, right? But it's a little different. People don't look at it as digitized as maybe it is or could be. And I think Bitcoin fills that mold. And I think the fact that institutions are adopting it more and more, it does lend it to be more credence filled and likely to survive and thrive.
Okay. Look, Gareth, if people are digging your outlook and your forecasts, I know you're every morning now, right? 9 a.m.
Right.
Eastern time, right?
That's right.
On YouTube with
the game plan. Yeah, I do a game plan every morning, about 20 minutes, just what's going on in the markets, hear what the charts are telling us. And I think, again, kind of what you mentioned before, it's all about probability, right? So most investors rely on social media for their information, which is very emotion filled, or mainstream media, which is, very narrative driven. And what I find is when I listen to those views, I usually lose money because I react emotionally to something going on. If I just look at the charts, the technicals, I make a decision based on probability. And all I care about being is the casino. I don't want to be the gambler, right? The casino, yeah, I'll lose sometimes, but over the long term, I win. And I think most investors want to move in that direction as well. So that's what it's all about.
That's what it's all about. I mean, really sound advice. It's so frequent that you see an investor marry their thesis, right? Or fall in love with their asset class. I see this in gold and Bitcoin all the time, for sure. Yeah. But that asset will never love you back. I guarantee you, no matter how much you love it. So every day, every weekday, 9 a.m., game plan. Gareth's now on YouTube. Check in 20 minutes every morning. By the way, that's a Herculean effort. People don't understand how much publishing every day. I mean, you're doing the work anyways, so I suppose now you're just making it public to a larger audience, but it's a Herculean effort, by the way. Yeah,
it is. It takes that. It's that additional energy, and you know it. You're on screen here with me. To have that energy and to be succinctly thinking through things where you say it and it sounds good, and you get your points across. It is a little extra effort for sure. And
great follow on X, unless you're in Brazil, at Gareth Soloway. So look, man, appreciate your time. Thanks so much for coming on. We got to do this more often, man. It's been too long.
I agree, buddy. Thank you so much for having me.
All right.